Before we start, if you want to actually understand how money works, instead of just guessing your way through life, hit subscribe, drop a like, and leave a comment with the one financial topic you still don't fully understand. It helps this channel grow, and it helps me make more videos like this one. Now, let's get into it. Money is not complicated. It's made to feel complicated. Banks, governments, and financial institutions benefit when the average person doesn't understand how the system works, because confused people make worse decisions with their money. This video is going to strip away the jargon and give you a clear, professional breakdown of how the financial world actually operates. By the end, you'll understand taxes, banking, interest, inflation, recessions, credit, currency, investing, and the two forces that separate wealthy people from everyone else. Let's begin with the one thing everyone complains about and almost no one understands: taxes. Every payday, a portion of your income disappears before it even reaches your bank account. Federal income tax, state tax, Social Security, Medicare. It feels like money vanishing into a black hole, but every one of those deductions has a specific purpose. Income tax funds the government's general operations: infrastructure, defense, public services, education. It's calculated on a progressive scale, meaning the more you earn, the higher the percentage you pay on each additional bracket of income. This is different from a flat tax, where everyone pays the same rate regardless of income. Sales tax works differently. It's applied at the point of purchase, meaning it taxes consumption rather than income. This is why sales tax is often called regressive. It takes a larger percentage of income from lower earners, because lower earners spend a higher proportion of what they make. Then there's capital gains tax, which applies to the profit you make when you sell an investment for more than you paid. This tax rewards patience. Assets held for over a year typically qualify for long-term capital gains rates, which are significantly lower than short-term rates. This is one of the most overlooked incentives in the entire tax code. The government structurally rewards long-term investors over short-term traders. Social Security and Medicare are payroll taxes, and they function differently from the rest. Social Security is essentially a forced savings and insurance program. You contribute now, and in return, you receive monthly payments after retirement based on your lifetime earnings. Medicare funds healthcare coverage for people over 65 and for individuals with certain disabilities. Neither of these taxes is optional, and neither is really a tax in the traditional sense. They're close to a mandatory pension and insurance system. Filing taxes is where most people get anxious, because the process asks you to estimate your own liability, and getting it wrong carries penalties. But once you understand the categories, the process becomes mechanical rather than mysterious. And here's a broader observation worth sitting with. Countries with higher tax rates tend to have stronger public infrastructure, education systems, and healthcare outcomes. Taxes are, in a very real sense, the price of a functioning society. The question isn't whether taxes are good or bad. The question is whether they're being spent efficiently, and that's a debate worth having with actual numbers, not emotion. Now let's talk about banks, because most people have a fundamentally wrong mental model of what a bank actually does. The common assumption is that a bank is a vault. You deposit money, and it sits there waiting for you to withdraw it. That's not how banking works. When you deposit money into a bank, that bank doesn't just hold it. It lends the majority of it out to other customers, businesses, and borrowers. This system is called fractional reserve banking. Banks are only required to keep a fraction of total deposits available at any given time, because under normal circumstances, not every depositor withdraws their funds simultaneously. This system is what allows banks to generate the loans that fuel mortgages, business expansion, and personal credit. It works because of trust and probability. But it's also fragile, because if enough depositors lose confidence at the same time and attempt to withdraw everything at once, the bank doesn't have enough liquidity to cover it. This is called a bank run, and it's exactly what triggered parts of the 2008 financial crisis, when confidence in the banking system collapsed and institutions couldn't meet withdrawal demands. So why do banks want your deposits in the first place? because they profit from the spread between what they pay you in interest and what they charge borrowers in interest. If a bank pays you 0.5% on your savings account and lends that same money out at 7% for an auto loan, the difference is their profit margin. You are functionally the supply side of the credit market, and borrowers are the demand side. In the United States, deposits are insured by the FDIC up to $250,000 per depositor per institution. This insurance exists specifically to prevent the kind of panic-driven bank runs that caused historical financial collapses. Understanding this distinction, that a bank is a lending institution, not a storage unit, changes how you think about interest rates, loan terms, and where you choose to keep your money. Which brings us to interest, the single most powerful force in personal finance, for better or worse. Interest is the cost of using someone else's money over time, or the reward for letting someone else use yours. There are two types you need to understand completely: simple interest and compound interest. Simple interest is calculated only on the original amount, the principal. If you borrow $1,000 at 5% simple interest annually, you owe $50 in interest every year, no matter how long the loan runs. Compound interest is different, and it's exponentially more powerful. Compound interest calculates interest not just on the principal, but on the interest that has already accumulated. This means your debt, or your investment, grows on top of itself. On the borrowing side, this is dangerous. Credit card debt often compounds monthly, meaning unpaid interest gets added to your balance, and next month you're paying interest on that interest. A relatively small unpaid balance can snowball into a significant financial burden within a few years if left unmanaged. On the investing side, this exact same mechanism becomes your greatest asset. If you invest money at an average annual return of 7%, which is roughly the historical inflation-adjusted return of the stock market, your money doesn't just grow, it accelerates. In the first few years, the growth looks modest. But because each year's return is calculated on an increasingly larger balance, the curve steepens dramatically over decades. This is why financial advisors constantly repeat one phrase: time in the market beats timing the market. Compound growth needs time to work, and the earlier you start, the more decades you give it to accelerate. The practical takeaway is simple. When you're in debt, especially high-interest debt like credit cards, compound interest is working against you, and the priority should be eliminating it as fast as possible. When you're investing, compound interest is working for you, and the priority should be leaving it alone and letting time do the work. Now let's address inflation, a concept everyone experiences but few can explain precisely. Inflation is the gradual decline in the purchasing power of money. It's not that your money disappears, it's that the same amount of money buys less over time. A $5 bill is still legally worth $5, but what it can purchase shrinks year after year. Inflation is typically measured using the Consumer Price Index, which tracks the average price change of a broad basket of goods and services over time. There are a few core causes. Demand pull inflation happens when consumer demand outpaces supply. If more people want a product than there are units available, prices rise to balance the market. Cost push inflation happens when the cost of producing goods increases due to supply chain disruptions, higher raw material costs, or labor shortages, and businesses pass those increased costs on to consumers. There's also a psychological component called inflation expectations. If people and businesses expect prices to keep rising, they raise prices and demand higher wages preemptively, which becomes a self-reinforcing cycle. A small, steady inflation rate, typically around 2% annually, is generally considered healthy for an economy. It encourages spending and investment rather than hoarding cash, and it gives central banks room to maneuver. But when inflation spikes well above that target, it erodes savings, outpaces wage growth, and destabilizes economic planning for both households and businesses. To control inflation, central banks primarily use one tool: interest rates. When a central bank raises interest rates, borrowing becomes more expensive across the entire economy. Mortgages, business loans, credit cards. This discourages spending and borrowing, which reduces overall demand, which in turn cools price growth. It's a blunt instrument, and it often slows economic growth as a side effect, but it's the primary lever available to manage inflation at a macroeconomic level. This naturally leads to recessions, the other side of the economic cycle. A recession is technically defined as a decline in economic output measured by gross domestic product for 2 consecutive quarters. In practical terms, it means businesses are producing and selling less, which leads to layoffs, hiring freezes, and reduced consumer spending. Recessions aren't random. They're part of a broader pattern called the business cycle, which moves through 4 phases: expansion, peak, contraction, and trough. During expansion, employment grows, spending increases, and businesses invest in growth. At the peak, the economy is operating at or near full capacity, and further growth becomes harder to sustain. Contraction is the recession itself, where output falls, unemployment rises, and consumer confidence drops. The trough is the bottom of the cycle, the point where conditions stabilize before expansion begins again. Recessions can be triggered by several factors: aggressive interest rate hikes designed to fight inflation, asset bubbles bursting, as seen in 2008 with mortgage-backed securities, external shocks like pandemics or geopolitical conflict, or simply the natural correction after a period of excessive growth and speculation. Governments and central banks respond to recessions using 2 primary tools. Monetary policy involves lowering interest rates to make borrowing cheaper and encourage spending. Fiscal policy involves direct government spending or stimulus payments to inject money directly into the economy. Neither tool works instantly. Recessions typically resolve over a period of months to a couple of years, and while they're painful, they're also a normal recurring feature of any market-based economy, not a sign of permanent collapse. Let's move to something that affects nearly every major financial decision you'll make: your credit score. A credit score is a 3-digit number, typically ranging from 300 to 850, that quantifies how reliably you repay borrowed money. It's not a measure of your wealth. You can have a low income and an excellent credit score, or significant assets and a poor one. It's purely a measure of borrowing behavior and trustworthiness from a lender's perspective. The score is built from 5 weighted factors. Payment history carries the most weight, roughly 35%, and reflects whether you've paid your bills on time. Credit utilization, around 30%, measures how much of your available credit you're actually using. Lower utilization signals lower risk. Length of credit history accounts for about 15%, rewarding accounts that have been open and managed responsibly for longer periods. Credit mix, about 10%, reflects whether you manage different types of credit responsibly: credit cards, auto loans, mortgages. New credit inquiries make up the remaining 10%, since opening several new accounts in a short period can signal financial stress. A higher credit score translates directly into lower interest rates on mortgages, auto loans, and credit cards, which over the life of a loan can mean tens of thousands of dollars in savings. This is the part most people underestimate. Credit scores aren't just a formality, they're a direct multiplier on how much your debt actually costs you. Building strong credit isn't about being wealthy, it's about being consistent. On-time payments, low utilization, and patience over time. Now let's step back and talk about currency itself, because this is where most people's understanding breaks down entirely. Money has no intrinsic value. A dollar bill is a piece of paper. A digital balance in your bank account is a number in a database. Neither has inherent worth. Currency functions because of collective, socially agreed upon trust. We accept a dollar as payment because we're confident that someone else will accept it from us in return. That's the entire foundation of any monetary system, whether it's the US dollar, a foreign currency, or a decentralized digital asset like Bitcoin. The core principle is identical. Value exists because a large enough group of people agree it exists. Governments issue currency, and central banks regulate its supply. This regulation matters enormously. If too much currency enters circulation relative to the goods and services available in an economy, each unit of that currency becomes worth less. This is inflation, again. If the money supply is too restricted, borrowing and spending stall, and economic activity can grind to a halt. Managing this balance is one of the primary responsibilities of a central bank. and getting it wrong in either direction has serious economic consequences. Understanding currency as a trust-based system, rather than something with fixed, objective value, is essential to understanding everything else in finance. Now to the topic that actually builds wealth: investing. Investing means putting your money into an asset with the expectation that it will generate a return over time, rather than letting it sit idle and lose value to inflation. There are four major asset categories worth understanding. Stocks represent partial ownership in a company. As the company grows in value, so does your ownership stake. Bonds represent a loan you make to a government or corporation. In exchange, you receive regular interest payments and the return of your principal at maturity. Funds, including index funds and mutual funds, pool many stocks or bonds together, allowing you to diversify across dozens or hundreds of assets without having to select each one individually. Real estate involves purchasing physical property, either for appreciation in value, rental income, or both. Each of these carries different levels of risk and return. Stocks generally offer the highest long-term growth potential, but come with more volatility. Bonds are typically more stable, but offer lower returns. Real estate can generate consistent income, but requires more capital and active management. The right allocation between these depends on your timeline, risk tolerance, and financial goals. And this is genuinely something worth researching further or discussing with a licensed financial advisor, since individual circumstances vary significantly. The single most consistent principle across successful long-term investors is this: wealth isn't typically built through picking the perfect stock or timing the market perfectly. It's built through consistent contributions, diversification across asset types, and enough time for compound growth to take effect. The greatest risk isn't market volatility, it's staying out of the market entirely and watching inflation erode your purchasing power year after year while your money sits stagnant. Let's talk about value, because this concept explains why certain people and certain companies earn dramatically more than others. Value is not an objective, fixed property of an object or a service. It's a perception shaped by scarcity, utility, and demand. Gold is a clear example. Chemically, it's just a soft, relatively unreactive metal. What makes it valuable is its rarity, combined with centuries of cultural and economic consensus that it's worth protecting and trading. This same principle explains income disparities across professions. A surgeon earns significantly more than entry-level retail employee, not because surgery is inherently more difficult in some abstract sense, but because the value delivered, saving lives, requires years of specialized training that very few people can provide. And the consequences of that value are extremely high. Companies operate under the same logic. A product that solves a widespread, painful problem for millions of people commands enormous value, and therefore enormous revenue, because scale multiplies the impact of that value. This also explains why brand perception drives pricing far beyond material cost. Two handbags made from similar materials can be priced 100 times apart because one carries a brand identity that customers perceive as higher value, whether that perception is about craftsmanship, status, or exclusivity. Understanding value as a function of perception, scarcity, and impact, rather than raw material cost, is one of the most important shifts in thinking for anyone trying to increase their own earning potential. Finally, let's talk about the resource that ultimately determines how much of all of this matters to you: time. Time is the only truly finite resource in personal finance. You can earn more money. You can rebuild credit. You cannot manufacture more time. Most people trade time directly for money through employment. An hour worked equals a fixed amount earned. This model has a hard ceiling because there are only so many hours in a day. Wealth builders operate differently. They use leverage, skills, systems, other people's labor, or invested capital to decouple their income from the hours they personally work. But even more fundamentally, they use time as an investment variable. Because compound growth is exponential rather than linear, the earlier money is invested, the more time it has to accelerate. A modest amount invested consistently in your 20s will often outperform a much larger amount invested starting in your 40s, purely because of the additional years of compounding. This is the core insight that ties every topic in this video together. Taxes determine how much of your income you keep. Interest determines whether debt or investment growth works for or against you. Inflation determines whether your money holds its value. Credit determines how much your borrowing costs you. And investing, combined with time, determines whether your money eventually starts working harder than you do. None of this requires luck. It requires understanding the mechanics, making consistent decisions, and giving those decisions enough time to compound. That's the entire game, understood clearly without the noise. If this video actually helped you understand how money works, do 3 things right now. Subscribe so you don't miss the next breakdown. Like the video so more people who need this see it. And drop a comment telling me which topic you want explained next. Taxes, investing, credit, or something else entirely. I read every comment, and your requests directly shape what I cover next. See you in the next one.